Welcome back to America's Commercial Real Estate Show. I'm Michael Ball. This segment is brought to you by CommercialAgentSuccess.com. If you're interested in learning more about selling or leasing commercial real estate, check them out. Well, today we are talking about investing in real estate through a self-directed IRA. Please welcome my next guest. It's Paul Ruiz. He is with the Entrust Group. He's Director of Professional Development. JP, thanks for being with us here today in studio.
Thank you for having me today.
Well, JP, it seems like timing is interesting in life, love, and war, right? What about the timing today for people why are some people kind of thinking about maybe investing in real estate in a self-directed IRA today?
Well, I think first, you're right. It's a great opportunity to explore other types of investments that are allowed to be held under a retirement plan. Because there's a growing population of a group of people born between 1946 and 64 called the baby boomers. There's about 78 million of them. And the concentration of baby boomers are reaching that retirement age. And there's about 10,000 of them that turn 60 every day. 60 every day, 10,000 of them.
Wow.
A lot of them are asking provocative questions that they didn't ask during their working years because they were still working. Yeah. Now they're reaching that age that they're going to start thinking about what assets do I have to use for retirement. Or in other words, when I slow things down, how can I tap into this amount of wealth that I've accumulated, right? Now, a lot of them have been invested in mutual funds, stocks, bonds, to say the least, but mostly a lot of them are in mutual funds. And a lot of them are saying, I cannot handle another market crash. Right. What other options do I have? And that's why I'm here today, is to talk about that great opportunity. Yeah. There's about $26 trillion in retirement plans today, and a lot of them are held by these baby boomers that are asking that question. Are there any other options? Well, real estate is an option. Yeah. What happens is that when a person has a 401k plan, as an example, they've worked for a large company, and they reach that retirement age. In other words, whether it be 59 and a half for the plan, up to age 65, that's the maximum age. They can take that money out and roll it into an IRA. If that's what they choose, right? Their options are broader. In other words, they have more investing options. And that's one thing that they can talk to their CPA, their attorneys, or maybe even their real estate broker if they wanted to get involved in something like that. Because assets that are rolled over into an IRA but is held under what we call a self-directed IRA custodian, which we're just one of them. Right? Yeah. A self-directed IRA custodian really does not offer any investments. Yeah. But the great feature about a self-directed IRA custodian is that the investor can actually choose the investment they would choose to hold under that retirement plan. And in this case, it could be a traditional IRA, it could be a Roth IRA, and for some who are retiring, they're actually going back to business as well. So if they're an entrepreneur now, or if they're a sole proprietor, and they're going back into business, they can actually still open up an employer-sponsored plan. Like an individual 401k plan, a SEP plan, a simplified employee pension plan, which contributions actually go to an IRA, or a simple IRA plan. The contributions to those accounts, whether it be via what we call a rollover from a 401k plan or actual contributions, can be invested in a broader array of investments again, and real estate's one of those.
And why do you think that it hasn't been used that much, or why aren't people that are investing in the stock market, and maybe they are concerned that they don't want to take another hit, why aren't more of their existing plans in hard real estate assets?
Why aren't they more in real estate assets? One of the biggest things in the 401k world is that the employer is always responsible, has the fiduciary obligation over the investments under their employee benefit plan. Yeah. Real estate is not one of those prudent type of investments that could be offered, let's say, to 300 people, right? But there are funds out there that could be placed in a 401k plan, like a REIT or some sort of managed fund in real estate. And you're finding that a little bit more common. Yeah. But individual pieces of real estate, you won't find that typically in a 401k plan, unless, of course, you have a 401k plan that does not employ any rank and file employees. That's how the IRS calls it. In other words, you don't have any people working for you. It's only owners. Yeah. Because 401k plans are typically subject to what we call discrimination rules, discrimination testing. With the onslaught of lawsuits that are happening with employers that are offering investments that have not performed very well, such as employer stock as an example. Right. employers are shying away from those non-traditional types of investments being held in a 401k plan.
Right.
It's not that it's not available, they just try to shy away from it. But once those assets become available to the individual via what we call an IRA, which stands for Individual Retirement Arrangement, the individual themselves can actually choose the investment that they choose to hold under their account. And there are two types. There's traditional, which typically are assets have never been taxed before or tax deferred. Another way I explain that is you're prolonging your agony. Because eventually you're going to have to take that out and you're going to have to be taxed on it.
Yeah.
But depending upon when you take that out will make a big difference.
Yeah.
As a matter of fact, right now in the forefront in the news is that there's legislation that's coming up that could change the way we get taxed.
Yeah.
Why is that important? Because the money that they take out of a retirement plan, called a traditional IRA as an example, or a 401k plan, is includable as part of the individual's taxable income for the year. So in other words, if you're only expected to make this much and you take a distribution from your IRA, that increases that amount, which therefore tells us that there could be more taxation involved.
Yeah.
That's why we're watching that very closely. But the other one is a Roth. In a Roth IRA, contributions have already been taxed.
Yeah.
But the best part about it is that the earnings will not only grow tax deferred, but if they satisfy what we call the qualified distribution criteria, the earnings will be distributed, here we go, tax-free.
Wow.
I love that. The reason why I said it because there's a big difference between tax and tax-free.
Oh, yeah.
Imagine if the money that you work so hard for, right, is going to be taken out and Uncle Sam is on the background, or the state might even be associated with that and saying, come to me, you're going to have to pay a portion of that to me. Wouldn't it be nice to have an account that when you take money out, all of it's yours?
Yeah. And also, I think one of the things that you're mentioning earlier was also it's control. It's your account.
That's right.
And maybe you know real estate. If you're listening to a commercial real estate show or watching it, maybe you understand commercial real estate and maybe you like to control your environment. It's like we invest in these companies, you don't know what's really behind them and what could happen.
That's right.
Right? But maybe you like real estate and you understand it, right?
Yeah. Yeah. The great thing about investing for retirement is that you don't have to put all your eggs in one basket. This show is not, the talk that I'm giving is to tell people to get out of this particular investment space and go to this other investment space. All what we're trying to tell people is that you have an opportunity to diversify your portfolio.
Exactly.
Yeah, there are options out there. You're not just stuck with picking one mutual fund over the other. Still stay in that, but explore some of your assets in some of the things that you may feel comfortable investing in.
And you think about it, you said it earlier, you get two big benefits of real estate, right?
Yeah.
You have the cash flow, and then you have the appreciation over time, and inflation. I think that's a big part of diversifying into real estate in your retirement account. Is we all know things go up in price. Everything costs more in 20 years than it did today.
That's right.
So that's a great way to put it in there. So you need a custodian.
Yep.
So how would a listener, a viewer of the show, pick a custodian? What should they think about? What should they ask?
They would ask a few things. Number one, is the custodian willing to take the particular investment that you're choosing, number one? Yeah. They are self-directed IRA custodian. Some self-directed IRA custodians have limited the type of investments that they would hold. Because keep in mind, there's only 3 investments that you cannot hold in an IRA. 2 of them are legislative, one of which is a life insurance contract, which is smart. Wouldn't it be a great racket? You had a term life insurance in there, paying $10 a month. If you die, $250,000 goes in there. Great racket, not allowed. Number 2 are collectibles. At first, they didn't have this restriction. You can't have collectible cars. You can't have, a rug to you, a special rug to you might be a garage sale item to me. So Congress said no more collectibles. Very hard to value, so on and so forth. It's problematic. And last but not least are S corps. Since an IRA is a trust, it's a valid trust under state law. It cannot be a shareholder of an S corp. But besides those 3, you can hold anything you want. As long as you don't self-deal. That's another thing we can talk about at some point as well.
And so some custodians are not going to allow real estate, right?
Some may not because they don't have the infrastructure to handle it.
Right.
Now keep in mind, in a piece of real estate, there are expenses, property taxes, maintenance, all sorts of different things that the property itself could incur as expenses. If they don't have the infrastructure to do that, well, then that could be problematic.
And then I guess you need to ask the custodian how they handle paying more if there's a mortgage that's a non-recourse mortgage in there, if
Yep.
they will allow that, if they'll pay that, if they'll pay the taxes, and kind of what the cost is for these items.
In other words, if there are additional services that need to be performed, what are those services that they will perform, and how is it handled? So, for example, if there's a recurring expense on a monthly basis, as an example, how is the custodian going to do that, as well as how much do they charge for it? Some custodians don't charge for it, some do. So either way, because it takes people power to be able to do those things.
Right.
What are the additional costs involved? If there are additional tax filings involved, is the custodian going to assist them in doing that, or are they going to have to go to their competent tax advisor to do that and work with them in regards to accomplishing those tax filings as well? And then last but not least, of course, the fees. What are the fees?
Right.
Is it on a per asset basis? In other words, if you have 10 homes, are you going to be charged 10 separate times? Or is it going to be based on the value of the investment? Now, keep in mind, a lot of custodians that used to handle these particular self-directed IRA accounts typically were wealth management groups by large banks, because they had the incentive to be able to bring those assets in.
Right.
Because a lot of the wealthy have the non-traditional types of investments. But keep in mind, a lot of custodians, like the Entrust Group, was birthed out of the necessity to lower down the costs so that the average person walking off the street will be able to avail of these particular types of investments in their retirement accounts.
Right. And I guess most money in self-directed IRAs or an IRA would be pre-taxed. So when they sell or take distributions of the property down the road, they're going to be taxed then. But some folks might have some money in their IRA that they've already paid taxes on, right?
Correct.
So what should they watch out for form-wise?
Well, in a traditional IRA, as an example, starting in 1987, although assets typically have never been taxed before, for the first time in the life of our taxation here in the United States, individuals could actually not take a deduction for their contribution. In other words, another way to look at that is that the contribution that you're making is already taxed.
Right.
The technical term for that is what we call a non-deductible contribution. Yeah. If you're going to put money in an account that eventually will be taxed, but you've already been taxed on those dollars in the year of contribution, would you want to keep track of that? I would say yeah.
Yeah.
The IRS form that the IRS created for that tracking is what we call an IRS Form 8606. The IRS Form 8606 has been around for a long time. Now, keep in mind, if it's been there for a long time, could people have forgotten that form has been filed?
Right.
Yeah, that's right. And sometimes the practitioner you were working with no longer practices.
Right.
So it might be good to dig up those records now that you're reaching retirement age, as an example for some,
Right.
10,000 of them turning 60 every day,
Right.
to take a look at those forms, gather the data,
Right.
so that those dollars will not get taxed again when you distribute it.
Yeah.
Another thing that a lot of people don't realize is that the assets that you have in an IRA could be inherited by somebody else.
Yeah.
And they have no clue about the record keeping that has occurred throughout your life when you were alive.
Yeah.
So the executor of a person's estate may need to be briefed as part of your estate planning process.
Yeah.
To make sure that the 8606 is there. If you have 2 children that you're leaving it with, that has to be split into 2. Then at least the proportionate share of each one will enjoy the tax-free distribution of those assets that have been taxed already.
Right. You already paid taxes. You don't want to do it twice.
That's right. You don't
Yeah.
want to do it twice.
And you may forget because you only do the 8606 when you put the money in. So you might have the IRA for 10 years and not file an
That's right.
8606, right?
That's
so
right.
you got to remember, hey, when you pull it out, we need to file it.
That's right. That's right.
Yeah.
Yeah, we get calls all the time. I have a non-deductible IRA. I said, there's no such thing. Because all IRAs that the person owns is looked at as one big IRA by the IRS.
Yeah.
And that's that form is the thing that gathers all the data to determine taxation at the end of the year.
Right. Now, how might our audience use a self-directed IRA and real estate for estate planning purposes?
Well, that's a good question. A lot of people who are reaching certain ages are asking, again, provocative questions such as, I'm not planning on dying tomorrow, but what would happen if I died? There are beneficiary options built within the document. And if it's a traditional IRA, I'm going to go technical, it's Article 4. And if it's a Roth IRA, it's Article 5. Those types of, that article needs to be discussed with their competent estate tax planner, because there are typically 2 options that the IRS gives you on how you can slow down the taxation of those assets. In other words, it's not talking about how you should take the assets out, but it talks about what are your options to postpone taxation. Isn't that great that the IRS and the Congress actually built in that when you die, it doesn't automatically all get taxed. It can be incrementally taxed or fully taxed within a certain period of time. Let's talk about those two real quickly, then at least since you brought it up.
Yeah.
The first one is what we call the life expectancy payment option. I call it the little chunk option. If you inherited $500,000, you know what the tax is on $500,000 if you were forced to distribute the full amount in one shot. The option of taking small life expectancy distribution is an option to defer taxation on the rest of the amount by only distributing a small portion, a little chunk, based on the life expectancy of the inheritor. For example, a person inheriting is age 30. The life expectancy that the IRS has on a table that can be found is 51. You know what that means? That beneficiary could prolong the taxation of those assets for 51 years by taking small distributions for 51 years.
And would you need to decide some of that when you set up that self-directed IRA, or just set that up in your estate?
When you set it up, when you set up a self-directed IRA, that option is really not something you need to talk about. The conversation occurs after the IRA holder dies.
I see.
Now you're faced with a beneficiary that has no clue. Number one, that they actually inherited an IRA. Number two, what that document contains. It's a good thing to start having conversations with beneficiaries that you may have elected to name in your IRA. So that they're prepared when something happens. You know what? Every major holiday, we're approaching Christmas, and we just had Thanksgiving. Every form called a beneficiary designation sometimes gets modified. So this is a good time to talk about it when family members are there. You don't have to talk about it as a group, but talk about it as individuals, because some people don't even remember when they named. Or their life may have changed. You know.
Yeah, that's very true. So you guys at Entrust, you not only are custodians, Entrust Group, but you also train in this area, right?
That's my department. The reason why I was brought into Entrust is to develop the education part, not only for our clients, which we produce webinars on a monthly basis to educate on a high level what it is to hold a particular investment. And examples like real estate, what are the things that you face, what are the mistakes people have, such as, you can't pay the earnest money out of your pocket since it's your IRA, it has to be paid out. I mean, things like that you'll learn. But also, in my background, being the head of consulting that consult with over 3,500 financial institutions, I built a school through the American Banking Association, through the Institute of Certified Bankers, as a preparatory course for institution professionals that would like to take and sit for what we call the Certified IRA Services Professional exam. So if people have the CISP designation, it means that they've been vetted out, and they should know the procedures that are associated with having an IRA. And of course, a self-directed account. It talks about prohibited transactions, all those different things.
And at your website, entrustgroup.com, is there some information there that the audience could learn more about using a self-directed IRA to invest in real estate?
Absolutely. There is a tab in our website, Investing in Real Estate, and it drops down all these different topics that they could click on to be able to answer the question that they have. Again, along with that, we also have webinars. Then you can talk to people like me online, or just contact our 800 number. I'd like to speak with John Paul or one of our business development managers, and they'd be more than happy to walk them through that process.
What's the biggest mistake to end the show here today? What's the biggest mistake that people should make sure they avoid investing in real estate through a self-directed IRA?
I think separate from a mistake, I think the notion that they are the ones investing. Of course, they're the ones directing, but it's actually the IRA that's involved in taking the dollars inside that IRA and investing in real estate. And the reason why I put it in those words, is the fact that it's the IRA that's actually the one buying a piece of real estate. Although it's the IRA holder directing the custodian to do such thing. Because keep in mind, in a retirement world, as long as those assets don't fall into the hands of the IRA holder, in other words, the IRS calls that as constructive receipt, it's not taxable. That's why it's good, number one, if you're going to buy a piece of property, the purchase agreement has to be under the name of the IRA.
Okay.
Earnest money has to be under the name of the IRA.
Okay.
If the IRA is going to borrow money to be able to purchase a piece of property through, you brought it up, a non-recourse loan, it's the IRA that's purchasing it. It's not the individual. So the individual cannot extend credit to purchase that property.
So the loan is to the
IRA. The
right.
underwriting guidelines are different. The loan to value is different.
Yeah.
The interest rate is different. The payments all have to come back to the IRA. Expenses have to be paid from the IRA.
Yeah.
So from a general perspective, if they get to the, you, a listener, can get to the thinking of, oh, it's my IRA that's buying and it's not me,
Right.
but I'm just using that as a funding vehicle for my retirement,
Right.
then you've taken a leap, a large step in regards to understanding how this whole thing works.
Right. And it makes sense. And, you think about the diversification, I think, you mentioned earlier when we started, can you really take that hit again?
Yeah.
You want to diversify a little bit and have some real estate that, hey, maybe 20 years from now, maybe that real estate doubled in value.
Absolutely.
And it had some cash flow. If you had a non-recourse loan, maybe it also had some principal reduction.
Yeah, which actually, absolutely. And another thing that a lot of people are looking at again is that legacy planning piece. A lot of them, shockingly enough, a lot of people are saying, because I don't know if you know this, but in traditional IRAs, when you reach a magical age of 70 and a half, you're going to be forced to start depleting that account. So distributions have to take place. But some people are saying, I don't want to take that distribution because I'm really not saving this for me. Well, I asked myself, who are you saving it for? Well, somebody else. Which means that you're planning for somebody else to inherit this. The wealth that you've worked so hard to build up. Legacy planning. Yeah. Wouldn't you like to be able to hand over wealth to a next generation or another generation by a stream of incremental distributions based out of their life expectancy?
Yeah. Yeah.
For the rest of their lives.
Yeah.
That's a powerful tool.
Yeah.
And if it's a Roth, that other type of IRA that we kind of briefly talked about, how would you like to be able to hand it over tax-free?
I'd like that.
That's huge.
Yeah.
Yeah.
I prefer if my children would give me money, but well,
Yeah.
JP, thank you. Great information.
Yeah.
Thank you. Appreciate you being on the
Oh,
show.
thank you for having me.
Yeah. And thank you for joining us out there on the radio stations, iTunes, YouTube, or any of the podcast sites. We sure appreciate you being with us, or maybe you're at CREshow.com. Please comment, share, connect with us. We love hearing from you. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show.